Directors and officers. Liability insurance explained. Did you know that company directors can be personally sued for millions of dollars, even losing their homes and savings? That's where directors and officers liability insurance, or D&O, comes in. Directors and officers. Liability insurance is a type of liability insurance that protects the personal assets of a company's directors and officers and sometimes senior management if they are sued for alleged wrongful acts while managing the company. It is designed to cover claims made by shareholders, employees, regulators, customers, competitors, or other third parties arising from decisions or actions taken in their official capacity. What does D&O covers? A. Legal defense costs, for example, lawyers, court fees, settlements, judgments. B. Allegations of wrongful acts. C. Mismanagement of company operations. D. Breach of fiduciary duty, for example, not acting in the best interest of shareholders. A.E. Negligence in decision-making. A.F. Misrepresentation or inaccurate disclosures. G. Employment practices claims, for example, discrimination, harassment, wrongful termination. What are the exclusions? A. Fraud, criminal acts, or intentional illegal behavior. B. Bodily injury or property damage, which is covered under other liability policies. C. Professional services negligence, which is covered under professional indemnity insurance. The D&O liability is structured into three parts. Side A. The Side A protects individual directors when the company cannot indemnify them, like during bankruptcy. An example could be when the company goes bankrupt, and directors are sued by shareholders for mismanagement. Side B, it reimburses the company when it indemnifies directors. Side B reimburses the company for the costs it advanced paid on behalf of directors' legal fees, settlements. It reimburses the company for the costs it advanced paid on behalf of directors' legal fees, settlements. An example could be when a director is sued, and the company covers their legal defense. Side B then reimburses the company for those expenses. Side C covers the company itself, especially in securities lawsuits. An example could be when a securities class action lawsuit names both the company and its directors. Side C pays for the company's defense and liability. This three-layer structure ensures protection flows to the right party at the right time. Board members often ask, how much liability does each director carry? And how do we structure protection against it? The truth is, liability isn't divided equally among directors, it's shared. And any one director can be held fully responsible. That's why structuring your D&O insurance correctly is critical. Unlike property or car insurance, there's no fixed formula for valuing liability per director. Why? Because in many legal systems, directors face joint and several liability, meaning any one of them could be forced to pay the full damages. In most legal systems, directors face joint and several liability. That means if one director is sued, all may be sued. And if one can't pay, another may have to cover the entire judgment. So instead of assigning a dollar value to each director, insurers set a shared pool of coverage for the entire board and officers. Since liability isn't divided per person, the key question is, how big should the overall insurance limit be? This is determined by A. The size and financial strength of the company. B. The industry sector and regulatory environment. C. Geography. Some countries, like the US, have much higher litigation risk. D. Shareholder profile. Activist or institutional investors raise exposure. E. Claims history. D&O policies don't assign a fixed liability value to each director individually. Instead, the policy provides a shared limit of liability for all insured persons. For example, directors, officers, and sometimes the entity itself. Since there's no formula that pins liability to each director, risk managers and insurers use benchmarking plus scenario analysis. The benchmarking, comparing with similar companies, size, industry, and jurisdiction. For example, in the U.S., mid-size public companies might purchase in between U.S. $10 million to U.S. $25 million in total D&O cover. Large multinationals purchase in between U.S. $50 million to U.S. $200 million, approximately. The claims scenario modeling. Estimate potential legal defense costs, plus settlement judgment amounts in worst-case scenarios. Allocate proportionally per director. For example, if 10 directors, you could loosely say each faces 1/10 of total exposure. But liability is joint and several, meaning any one director could be held fully responsible. Regulatory and legal environment. In some jurisdictions, penalties fines are capped or more limited. In others, they're uncapped, for example, U.S. securities litigation. In short, structuring D&O liability is about one thing: making sure the insurance limit matches the company's true risk, while giving directors the confidence that their personal assets are safe. So next time you hear about D&O insurance, don't just ask, "What is it?" Ask instead, "How much is enough?" If you found this video helpful, don't forget to like, subscribe, and share it with someone who should know about D&O insurance.